You're tuned in to The Real-Evator with your host and fellow investor, John Adams, keeping real estate real and elevating you through sharing the stories of other real estate investors.
Hello and welcome to another episode of The Real-Evator. It's John Adams and I've got with me Referrals. We are starting an interview we previously recorded. We want to share with you today on how 1031 exchanges can help you in your real estate investing.
Somewhere to live. I had saved up a fairly good chunk of change, and at that young age, although I acted like I knew what I was talking about or understood what I was reading about in economics classes, I really didn't know much about inflation other than my money wasn't working for me. So my dad urged me to buy a house. I think he was really just sick of me sleeping on his couch. And I bought a house, and I stayed in that house for about 5 years. It was actually a really good location for me. It was great. It was actually in Jacksonville. I was going to UNF at the time, and I was near my parents, yet I wasn't with them anymore. I was in close proximity to the beaches, but over the ditch, and I could get to school relatively easy. And of course, I was running my dad's offices here on the island, so it was a quote perfect location and perfect setup for me, and it gave me a real quick learning lesson in compound interest and how mortgage amortizations work, as well as that sweat equity concept and just building wealth for yourself.
Good question there. Do you still own the home today?
No, although it was quote the perfect property for me. I held that house for 5 years, which is pretty typical for a first-time buyer, maybe a little longer than most. But I sold that property and then I bought another, and I still own the one that I replaced it with. And since then, I've bought and sold numerous.
Now, I think one of the main themes of what we're going to talk about today, there's a lot of questions, there's a lot of misconceptions, there's a lot of people that want to use a 1031 exchange. It's a really sophisticated tax deferment plan that a lot of people overlook. And it's pretty significant in what you can do with it. And both you and I have had similar experiences. You've done a really good job at doing that, which is leveraging that as a tool.
Yeah, so it is exactly that. It's a tool in the tool chest. It's not the be-all, end-all. It doesn't save all of or doesn't rescue you from problems, and it's not the end solution to your life, but it's one thing that we can do to really try to increase our net worth and defer our gains as long as possible. And I'm glad that you did very specifically say 1031 tax deferred exchange, because a lot of people say 1031 tax free exchange, and we all know there is no such thing as tax free, period.
Yeah, you're going to pay taxes at some point in time.
You got it.
There's two expectations in life, and taxes are one of them.
And death is the other. You got
so
it.
You're going to pay, even if you're dead, you're going to pay taxes.
Absolutely.
Absolutely.
So yeah, it's been real good. I've used them a few times, back in the heyday, and I reference the heyday being 2004 to 2007 or so. We heard about them all the time. And then of course, 2007 to 2015, you didn't really hear about them too much because most people had a loss at that time. We weren't deferring gains. We were trying to cut our losses and get out of the problems we created for ourselves. And now you see a lot more 1031s. There's a lot of providers out there, and it's become a really streamlined, simple process that I'm no expert at, but we've got expert connections that handle our affairs for us.
So back up and punt for 2 seconds. There might be some people out there that are like, okay, well, I've heard about a 1031. I think I know. But in layman's terms, somebody that's just trying to get started investing, maybe they're thinking about selling an investment property.
Sure.
Who should look at a 1031 exchange in its simplest form? What's the definition for you?
Sure. Well, you just answered that. Your question answered the question. So a person looking to utilize a 1031 for an investment property, it's an investor. It's not a speculator. It's an investor who has a gain or a taxable gain on a property they are selling. And there are certain criteria to it. On this podcast, please know that I'm not a CPA, nor should you construe this as legal advice. However, a tax deferred exchange is for investment property, and that automatically disqualifies a second home and a primary residence. So essentially it's an investment. That's all it is.
Well, I mean, and there are some lenders that will allow a second home if it's something that you rent out, but not something that you just live in constantly, perpetually.
Correct.
So just to clarify that.
Yeah, for clarification purposes, when I said second home, I'm referring to something that it's a second home, yet we don't rent it. Okay, and that's what a lot of people get hung up on. They want to do a 1031
For their primary residence.
or for a second home, but it's never been rented. It's just a second home.
Thank you for clarifying.
You're welcome.
Awesome. So I've got a property. I am not living in it. I've either rented it out or maybe even it's inherited property.
Okay.
I want to sell the house, but I don't want to pay taxes on it yet.
Okay. Well, we all pay taxes at some point, but yet being the key.
Yet being the key. I would like to use that and maybe some other investment. You know, as an investor, as an agent, what strategy do I need to think about before I list or sell that house?
So let's say that you did inherit the property. The first thing I would do is I would actually speak with my tax consultant, and I would just really get a good idea of what my taxable liabilities are. If it's an inherited, is it subject to inheritance tax or whatever it may be? Because frankly, you know, depending on your current financial situation, you know, you may be in like a 10% tax bracket if you're retired. And if that be the case, it might just be advantageous to sell it now and take that tax hit.
Because it could be potential.
It could be a greater
Ordinary
tax
income.
liability later.
Okay.
Absolutely. So I would speak with my financial advisor. I would speak with my CPA. And just to go on record, I would say that anybody listening to this, you should have some close relationships in your life. Your CPA and your financial planner need to be one of those. And you should be meeting with those people twice a year, you know, to have these conversations and to plan. People that fail to plan are planning to fail.
Oh my God, Colin Powell
Did
quote.
you like that?
Oh,
Did you like that?
I like that.
Absolutely. So I would have a close relationship with them. But to answer the question, if it were me wanting to defer the gains and because of the bracket I'm currently in, yes, I would most likely sell that property. And I would in turn do a 1031, and I would find something that either I could get one or two properties and kind of diversify or at least allocate my asset, my exposure, or I would find that one property that'll generate really tremendous income over like a 2 to 5 year period. I'm a hold guy. I look to buy something and I plan to hold it for a minimum 2 to 5 years. However, if the right situation comes along and somebody's just throwing some money at us, we'll sell in the short term, but I always plan to hold.
And if you look in section 1031 of the tax code and you find this rule, it will tell you implicitly that it's not meant for flipping homes. And sometimes people misconstrue that and they think they can maybe buy a home, get some equity stripped out of it, and then defer that gain into another house. It's really not meant for that. I really would have you lean on your tax professional to give you some advice on that before you click on go with that kind of a strategy. But very similar to what I did back in 2014, I bought a home in North Carolina as a VRBO kind of rental situation.
Sure.
Now it just so happened that a year into the ownership of the house, one of my guests decided to offer me a substantial amount of money over what I paid for it because they liked it so much. I love that house, but as we said,
there's no perfect house out there, and they're all investments at the end of the day. You've
got to put your spot cap on, right?
You got it. You lose money when you get emotionally tied.
So if you put your spot cap on, I'm no longer in love with the home.
Come in peace.
Or whatever she said. So if there's no emotional attachment to the house and we're just dealing by the numbers, I really wasn't making money on that house.
Boom.
And so at the time, I found myself in a position where I could make $100,000. I hadn't held it for long enough for me personally to avoid a high increase of tax on those gains. So what I did instead of just selling it and paying taxes then on it is I did exactly what Brett said. I leveraged that to buy 2 duplexes in St. Mary's for long-term rental properties. So you've done something very similar where almost you've acted as dominoes very recently, and maybe that would be something good for other people to hear. I kind of did something illogical first. I bought a property just for renting out so I could maybe enjoy it a little bit and maybe defer the cost, not really make money. But then what I did in the second loop, now it's making me money. So how are you using that similar strategy for yourself to make equity positions?
So I've done a couple of these over the years now, and I don't always do a 1031.
Okay.
There was one situation where I owned a vacation rental property. I bought that property because the price was right. It was one of our seller clients. I just asked him if I could make him an offer. He said yes, and I've done a couple of those in the past. But nevertheless, I bought this property. I ended up renting it on VRBO. It was making a tremendous return, about 14%. And at the time, we had several people looking for identical properties, and there was no inventory. So one of them said, "Would you entertain selling yours?" And I said, "Absolutely, here's my number," and he paid that number. So rather than do a 1031 on that one, what I actually did was I had owned it for about 18 months. It was not a long hold, but I did just liquidate. I took my licks, I paid the tax, and I took that money and I paid off the mortgage on the other house. So I don't always roll that money into a next investment, but that particular one, I paid the mortgage off, threw a mortgage burn party, which you did not attend. I was very upset about that, but I think you were out trying to conquer the world somewhere.
Something like that.
Yep. So my celebration on that was to throw down versus roll the money into the next investment. Now, I recently did a domino type that you referenced, and with that one, I ended up buying a property, or a property came up, and I knew it was a good investment. I had no intentions of selling my other house. However, the inventory was tight, and I knew that at that price point in that area, it would sell relatively quick. So I made a arrangement with the seller of the new property, as we call the replacement property, and I put that one under contract. In the meantime, got the other one ready, marketed it, got it sold or under contract and sold, and then I activated the 1031. And it was basically a 4-day gap. So I closed on the relinquished property, and then a couple days later closed on the replacement property, and now we've got our next investment.
So that's kind of a way where we were talking about the domino, where you can actually take maybe just a few bits of coin for your investment. Similar to what he did, I bought a home. I put in total investment of about $20,000. Because of that investment, I was able to net back out about $100,000.
Yes.
Because of that investment, I was able to use a 1031 exchange to defer the gains into buying 2 duplexes, which I later netted into about $160,000, bought another condo, actually paid taxes on the other hand. Thanks very much. I appreciate that.
I got him that one, just saying.
And I didn't think I was going to be able to find another property. Lo and behold, I did. I should have actually 1031 that domino into a third exchange. And this is over a period of about 10 years. So that's definitely using the tax code as the way it was structured to be. So backing up just a little bit more, before I list a home that I know I'm going to need a 1031, this is the last mistake I've made. Before I even list it, before I even sign a for sale agreement, what should we do if we want to entertain a 1031? You said talk to your accountant, talk to your financial planner, see if it's the right fit, but then the next thing.
Yeah, so if it's the right fit, then we know that we're rolling into a 1031. And with that being said, we don't wait till the day we're leaving for a trip to pack the bags. We need to pack the night before. So what I typically do is I go ahead and start the paperwork, and I just reach out to one of our intermediaries, find out what the cost is, etc. The costs are usually very nominal, or especially as compared to the tax savings. Plus, it's an investment expense, so that is, again, a CPA thing that he can categorize that on your 1040. But nevertheless, I go ahead and start lining up the domino to where there is no break in, sequence. Look, I don't like surprises. I just want to be able to sell it and then literally it rolls right in to the intermediary's escrow account. And then from there, we've already got our property, our next one identified, or if we don't, we've got a certain time period to do that. And once we identify it, then we've got a certain time period to close. I like having my ducks in a row, so typically I've got mine already identified before I even close.
So tax advisor, financial advisor, after you're at that point, you have to find a QI or qualified intermediary.
Correct.
And these are 1031 exchange agents, and there's tons of companies out there.
They are. I go by referral. Everything I do in my business is typically by referral. That's how we met. We met by referral, and I want to know people that do business with the people I'm going to do business with.
So very important, if you're working with your financial advisor, with your real estate professional, definitely lean on them for who they like to use and who they've had experience with, so they can give you some guidance on that.
Yeah, and I tell you what, a great source for recommendations, talk to your closing attorney. If you're selling properties or if you're doing business with an attorney or a title company, they already know who to do business with. And you're paying them a closing fee, so why not get some free legal advice out of it too, and a recommendation. That's how I found ours. I referred ours to you, so it's been a good relationship, starting with my attorney.
So going back to that, so now, don't show up at the, closing table.
Oh, by the way.
I want to do a 1031. Is it too late?
It's a little late.
Yes. Yes, it's too late. So this is something you have to have a lot of planning in advance for, but it can be very beneficial. Also know that you have certain time frames to meet in naming properties. So
Yes.
You can't just willy-nilly close, put this in an account and just think you could hold on to it for a year. There's certain time frames.
Automatically disqualified in that situation, and you're paying taxes, which is stupid.
Yeah, because you've paid probably somebody $800 to $1,000 to set up something that you still have to pay taxes on.
Correct.
So that's just...
Correct. The intermediary's fee is due when you confirm that you're doing one. If you screw it up and take the money yourself, they've still done their task.
Yeah. So you have usually a period of days. What is it? 30 days?
Honestly, I can't remember offhand. I would recommend that you speak with a QI about that, qualified intermediary. However, if I recall, I want to say it was either 45 or 60 days.
I think it's 60 days. I'm going to post down below in the comments section actually the 1031 IRS code, so there's no ambiguity about what the ruling is, but it's either 30 to 60 days to name the properties.
Or better yet, if you really want some additional insight, give either John or myself a call. We'd be happy to at least point you in the right direction, because on the podcast, I'm not going to give you all the clues. You'll have to call us if you want more information. At that point, we'll probably hit you up for a referral.
So you have a certain number of days and a certain number of properties that you can name. And so after you name those properties, you actually have to close on one of them. So It's a little more cantankerous than just writing a couple of offers and hoping one sticks. So that's one of the other things about 1031 exchange. You do have to actually replace it, and you also have to replace it with equal or greater leverage.
Correct. You can't go down, because then you're subject to taxes on the amount of the discrepancy.
So by that I mean leverage. If I had $20,000, I invested in a $100,000 property, so I'm leveraged at 80%. I can't use my 1031 exchange earnings of $100,000 and just go pay cash for another $100,000 house. Can't do that. Otherwise, there would be a certain percentage of tax, or boot money is what we call the boot money. Yes, those are funds that are left either in the exchange or not used. Then you have to pay taxes on them, so it totally defeats the point of doing a 1031 exchange.
Totally defeated.
So that's why I went ahead and bought 2 homes at $150,000 that were duplexes. By doing so, I was equally leveraged to the home I owned previously, and was able to use all of that money without any of it going to boot.
Because John likes to hear himself talk a lot on this, I'll just make this really simple. I'm just going to make this really simple. Guys, you got to go penny for penny on the 1031. If you take out $100,000, or if your proceeds are $100,000 tax deferred, then you have to spend at least $100,000 on the next property.
Okay.
Okay, it's
That's
that simple. You got to go. It's got to be either a lateral or an upward trend in the price points.
There you go. All right. And there's other investments to talk to your financial about that. financial advisors can give you advice on some 1031 investments that are not necessarily real property, but real estate investment trust or other assets that you can own.
Correct.
So let's talk about that a little bit too. So you go to find your next properties. How long do you have to close on them? Actually, after you've named them and then you actually got a contract, you've got to close in a certain amount of time.
So full disclosure here, I don't know.
Good.
Full disclosure,
Good.
I don't know. However, the intermediary will guide you to that. And that makes for a perfect point as to what we talked about earlier. Guys, the 1031 is not for the person that says, we're gonna go on vacation, let's just get in the car and drive. The 1031 is for the guy that says, we're gonna go on vacation on this date, we're gonna book our airfare here, we're gonna fly to this location, and we've already got our hotel lined up. It takes planning for this stuff.
It does.
And
It really does.
planning, I think of the old saying, like, your life's too short to make all the mistakes in the world. Just look at other people's mistakes. And instead just call an intermediary and just commit yourself to doing one, and they will walk you through it. The way I look at it is, if I'm paying these people some money, I expect 110% service from them, and let them handle all of it. Knowledge bomb right there. Mic drop.
Well, we appreciate that from you. As a seasoned investor, as a real estate agent, we see a lot of things right now. And there's a lot of folks that are maybe even just getting their first step. Maybe they're not in a position to do a 1031. They just want to know more about it. So from your experience, and this is probably the most valuable thing you can give our listeners, what would you tell people to do? Obviously said surround yourself with a few different professionals in finance arena, CPA for tax advice, and maybe a proficient real estate agent that knows about investments.
Absolutely.
So are those all the keys, or do you need to have a special spreadsheet? Do you need to do some more planning? What would you suggest?
So what I would suggest is do what you're good at. If you're not a CPA, don't practice tax advice. If you're comfortable in the bond market, then stick with bonds. If you want to be good in real estate, you're going to look at a lot of investments, and sometimes the best deal we sign are the ones that we walk away from. Some of us can speak to that very well. Like, just because we have somebody doesn't mean we need to sign the deal.
Not kidding.
In investing, whether it be financials or real estate, the object is, like, don't lose money, because you have to work twice as hard to make that back. So the first step for me would be, what's the purpose of the 1031? Are we doing this for the right reason? Does our property qualify? And are we ready to roll back into more real estate, or do we want to just cash out? Sometimes I like sitting on cash versus property. And then, of course, you've got to have those networks. You got to have the attorney that you can lean on. You got to have the CPA. You got to have the financial advisor. You got to have the intermediary. You need a banker. You need a great banker, and I know one. If you guys need help, let me know. I got a great guy in Jacksonville. John's office is in Jacksonville. I'm just saying that. His main office. So yeah, I would rely on the people that are good at what they do. My attorney always says, nobody wants to pay the attorney. Well, that's not true. I tell him regularly, when I need an attorney, I am so happy to pay him for his services. So I would recommend you just align yourself with the right people, with the right connections, and bring value to them, and they will help you get what you need.
Hottest thing in real estate right now. What is working for investors that you know?
I think a lot of people are having trouble actually finding the right buys, quite frankly, because there's a lot of people in the market that say they're investors and really they're just speculators, and we've seen this before. What's working well for people? That's very simple. The good investors are aligned with agents and brokers who have been entrenched in a community for a long time, and they know what's going on in the market. They know about properties coming up prior to market. So I would recommend that you build a relationship with agents, quite frankly.
Awesome.
Deep relationships. Same thing with lenders.
Well, we appreciate you tuning into the Reelevator. If there's something that we can help you with, or if there's something that you would like to hear on our show, please feel free to reach out, DM us. If there's something obviously that you loved about the show, go ahead and subscribe. If you like it, go ahead and give us a thumbs. And we appreciate you listening and your sponsorship.